So at MLC, we tend to think we've got a fairly unique approach, particularly to asset allocation. So we have this thing we call the Investment Futures Framework. So it's a scenarios-based approach to thinking about how different assets are going to behave in different environments. So rather than suggesting we can forecast exactly what's going to happen, we tend to take a more humble approach and think, okay, what's the range of possible things that can happen? How do we best position for that broad range of outcomes? So it's not necessarily suggesting we have insight into the future. It's really thinking about, okay, here's a range of things that can happen. How do we best position ourselves for those? And we do that through this investment futures framework. So it's putting together a range of credible scenarios. Here's inflationary type scenarios, deflationary type scenarios, global catastrophes. We've got a pandemic scenario in there, which is obviously very helpful going into the first quarter of this year. So it's a broad range of credible potential outcomes. And then how do we now position our portfolios just to be able to accommodate that quite broad range of investment outcomes. I think that from our perspective, we think that's a fairly unique approach to think about asset allocation. Right now, there's a heightened uncertainty. So it's an environment of heightened uncertainty. And in an environment of heightened uncertainty, a lot of the scenarios are now credible. We've come out of what's been a disinflationary, deflationary environment for a considerable period of time, but given the reactions that are going on with central banks and particularly with governments, some of our inflationary scenarios are now starting to get a bit more credibility to them. And the reason I say that is governments are behaving differently than they did in 2008, 2009. So in the last episode, the last crisis we had, governments tended to put money into the system in more, I don't want to say backdoor mechanisms, but it wasn't straight into people's pockets. They did it through things like QE or quantitative easing, where central banks purchase a lot of existing debt securities. They did it through bailing out certain industries, banks, insurance, those sorts of things got bailed out during 2008, 2009. There wasn't money going into people's pockets. This time, the governments have specifically said, no, let's put the money straight where it's needed. So it's gone straight into people's pockets. JobSeeker, JobKeeper, the CARES Act was in the US. Go to any country in the world, they've all got their version of our JobKeeper. And it was designed specifically to get money into people's pockets. That is, at the end of the day, going to be inflationary. Now, the time between when the inflation occurs and when it becomes a problem, we don't know, and this is part of the scenario's insight. But what we do know is that some of our inflationary-based scenarios are now starting to get higher probabilities because of the reaction of governments. So that's sort of one indication of how we can get insights from that, not necessarily knowing what's going to happen, but entertaining the range of potential futures. So part of the strength, we think, of that investment futures framework is it helps us with asset allocation, but also gives us significant insight into how we want to invest in those actual assets. So it's not just the asset allocation itself, it's the way we get those types of exposures. And so at the moment, one of the keen insights we're getting out of the investment futures framework is make sure we're diversified. In an environment of heightened uncertainty, where, as I said earlier, there's a number of scenarios are now coming into play, it's really hard to prepare yourself in a concentrated way. Now, diversification gets bandied around as a bit of a catch-all phrase, I think, but in this environment, one of the key insights we're getting from the investment futures framework is be diversified. Make sure your drivers of growth, so the way you're getting returns in your portfolio, are really well diversified. Why? Because a lot of different things could happen. Governments could change the way they feel about shutdowns, lockdowns, opening up, the way people are going to react to safe behaviours that individuals, companies, even countries will have as a result of that. There's a really broad range of potential conditions that can change in a snap. So being really diversified or significantly diversified, having a number of different drivers of growth, we think makes a lot of sense. That's one of the first insights we're getting out of our scenarios process or investment futures framework.